Josh Vecchio here, mortgage broker with Hunter Galloway. In today's video, we look at what mortgage insurance is, how to waive it, and how to get the biggest bang for buck. So if you end up liking this video, it'd mean the world to me if you could subscribe. Thanks and enjoy the video. So how does mortgage insurance work? Well, back in 1965, the Australian government's House and Loan Insurance Corporation introduced lenders mortgage insurance to help people with a smaller deposit to get into the housing market. Back then, banks were after between a 20 and 30% deposit, and its introduction allowed borrowers to get a loan without needing such a large deposit. Lenders mortgage insurance is a one-off fee charged by the bank, and the insurance protects them. So if you're unable to pay back your loan, it'll pay the bank for any loss incurred. Generally, you're able to get this put on top of your mortgage so that you don't have to pay it up front, and the cost covers your mortgage for the life of the loan. So how is lenders mortgage insurance calculated? Well, it's really based on two factors, including your loan amount and your loan to value ratio. The higher they are, the higher the premiums and the more you pay in mortgage insurance. Let's take a quick look at the lender's mortgage insurance premium to understand how this works. So below is an example of the premiums that banks charge. Let's take a quick look and understand this in a bit more detail. So what we've got here to the left is your loan to value ratio, and to your right, depending on how much you're lending, will depend on the premium charged. So essentially, the larger your loan amount, as you can see here, and the higher your loan to value ratio, the bigger the premium. Now we're going to look at how much you're going to pay in mortgage insurance. I'm going to show you a few examples with our calculator, and I'm going to show you how you can do the same to find out the biggest bang for buck. So keep watching. Okay, great. Now we're going to look at 3 examples using our lender's mortgage insurance calculator. You can use this calculator by going and visiting our website here. I'll put the link below in the description, but all 3 scenarios will be based on a $600,000 purchase price or valuation. So the first example, we're going to have an 8% deposit. That's a 92% loan to value ratio. And the mortgage insurance on that is $21,859. So we'll go ahead and put that in our chart with an 8% deposit. Now, let's have a look at the next one, the 10% deposit. That's a $540,000 loan amount, or a 90% loan to value ratio. We'll go ahead and document that over here. And finally, we're going to look at a 12% deposit. So let's have a quick look at what that is. So we'll go a $528,000 loan, or an 88% loan to value ratio. So having a look at all of these on a graphical or on an Excel sheet, what we can see here is that there's a $12,000 difference, but there's quite a sizable change in your mortgage insurance, roughly $7,500. And in my books, for $12,000 in an additional deposit, to gain a discount on your mortgage insurance of $7,500 is totally worth it. So I'd encourage you to go over and get onto this calculator, find out how much mortgage insurance will be for you, and whether or not by putting a little bit more of a deposit in, you'll be able to get a big bang for buck, as we could see there. So can lenders mortgage insurance be waived? Yes, there are many reasons why your mortgage insurance may be waived without having to pay a 20% deposit. Sometimes lenders have promotions. At the moment, first home buyers are able to get this waived if you have a 15% deposit. Other reasons include if you work in a specific industry, and will mean the lender will waive your mortgage insurance up to 90% loan to value ratio. At the moment, industries which are eligible include finance, legal, entertainment, such as professional sports, singers, actors, health, and mining. Whilst you might not work in any of these industries, it still may not mean you'll be able to get your mortgage insurance waived. It's because banks require you to have a specific qualification and job title. So let's take one bank's eligibility criteria as an example. so we can get a feel for what this looks like. So for this lender, as a professional, to be eligible, you need to be a member of either the CA, CPA, CFA, or FIAA. This is the financial or accounting industry. Secondly, your job title would need to be one of the following: an accountant, actuary, auditor, chief financial officer, financial director, financial manager, financial controller, or partner. Finally, your household would need to be earning over $155,000 to meet their eligibility criteria. So as you can see, there are many hurdles to meet their eligibility, and each lender's eligibility vastly changes. And this example is just one of the lender's requirements. Each are vastly different. So then the question becomes, do you need lender's mortgage insurance? So whilst mortgage insurance is typically charged if you don't have a 20% deposit, there are many occasions where lenders will charge this even if you do have this amount. The most common is due to the bank's postcode restrictions. It's applicable when you typically buy a unit or a townhouse in a suburb which the bank has blacklisted. This will mean that to avoid mortgage insurance, you may need upwards of a 30% deposit. Another reason is if you're self-employed and haven't completed your most recent financials. This is known as a low documentation home loan. To avoid this, you'll need upwards of a 40% deposit. Other reasons range from the banks charging mortgage insurance even if you have a 20% deposit includes multi-million-dollar properties, unique homes, that's a unit under 50 square meters, if you're a temporary resident of Australia, a service department, student accommodation, and multiple properties on one title. And remember, if you like this video, feel free to hit that subscribe button. So how long do I have to pay mortgage insurance for, and is it transferable? So if I've paid it with one lender, can I switch to another lender, and will I have to not pay it again? So mortgage insurance is paid up front and is a once-off payable fee. This means you won't have to pay for mortgage insurance once again it's charged. But there's a catch, because if you've ever switched lenders, this premium is non-transferable. Let's back up a little. So let's look at the 4 insurers in Australia, which include QBE, Genworth, Arch Capital, and banks self-insuring. So for example, let's say your mortgage insurance was paid to QBE. If you're looking to refinance from, say, Bank A to Bank B, all things being equal, that is to say your loan amount, your loan to value ratio, that's meaning nothing's changed since you settled your loan with Bank A. When you switch to Bank B, even though you've paid the premium with Bank A and it's the same mortgage insurer, switching your home loan to Bank B would mean you'd pay your mortgage insurance once more. And essentially, it's highway robbery at its finest. Personally, I don't understand how this is even possible. Remembering that if the insurer is still QBE, they've already had the insurance paid from the Bank A, and that is to say, now with Bank B doing nothing except changing the lending offering. It essentially means that the mortgage insurer gets paid twice to insure the same property at the same risk level with the same loan amount. And it's ridiculous to say the least. So the only saving grace is when you're increasing your home loan, that is to say, to stay with the same lender, that you'll receive a premium for the mortgage insurance already paid. So if your mortgage insurance is $10,000 and you had initially paid $8,000, then you'd pay the difference with your home loan top up. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a mortgage broker, we can help. And you can visit us online at huntergalloway.com.au, or you can call us on 13 088 065. Thanks for watching, and I'll catch you next time.